Welcome everyone to another episode of How to Make Money in Stocks with Investors Business Daily. As you can see, Amy is out this week. She's in Minneapolis, so it's just me. Now we're going to talk about, since we've been talking about how it's been a really choppy market for many months now, we're going to take a look at the monthly charts of the NASDAQ and the S&P to get a sense of where we stand in the current cycle. But first, let's take a look at the market. So once again, this week showed that we're still in a seesaw market where we seem to take one step forward, then one, two, maybe three steps back, and the NASDAQ is a case in point. Last Friday, the NASDAQ rebounded from a loss to a small gain and seemed to add to that momentum on Monday and Tuesday. But then it bumped its head against the 50-day line and closed lower for 3 straight days. And if you look at the volume in recent weeks, you get a sense of investor sentiment. Just eyeballing it, you can see that the number of down days and heavy volume clearly outnumbers the number of up days. The S&P 500 has followed a similar pattern. Unlike the NASDAQ, the S&P had been trading above its 50-day line and had been finding support at that benchmark last week and again on Thursday. But on Friday, that came to an end and it closed below it, which is another sign for investors to be cautious. And that's confirmed by the action of IBD 50 stocks, which show the tug of war that's going on right now between the bulls and the bears. On the bearish side, you have stocks like Trex, which sold off sharply on earnings. It's a good reminder of 2 rules. One is be patient and wait for the stock to actually break out in heavy volume. Trex failed to clear its 50.72 buy point. And number 2, avoid buying stocks just before they report, because this is what can happen. The recent action of Sonic and other stocks like it show why this has really been a very frustrating market. The stock gapped up in March on earnings to break out of this cup with handle. Volume was 327% higher than normal, which is exactly what you want to see. But then look what happened. It gained about 10%, then gave it all back, and even slipped below the buy point. Downside volume, as you can see during that pullback, came in above average. Now on a more positive note, some stocks like Nvidia are showing strength. After reporting on Thursday, the chip designer for game consoles and mobile devices gapped up and held those gains. Volume was more than 600% higher than normal. Of course, now the question is, can it hold on to those gains and add to them? Or will it get caught in this crossfire, in this fight between the bulls and the bears? And also keep in mind that the stock has now entered the 20 to 25% profit-taking zone. So particularly in this type of market, it could be a good time to lock in at least some of your gains. Facebook is another IBD 50 stock that has been holding up well. Even though it reversed a bit after gapping up on earnings on April 28th, it found support at the buy point. As of Friday's close, it was still trading within a 117.09 to 122.94 buy zone. I covered 2 stocks this week in the IBD stock analysis, including Adobe Systems and medical products maker Zimmer Biomet. Both have been hovering right around potential buy zones. On Wednesday and again on Friday, Zimmer Biomet tried to clear a 117.87 entry, but it failed to close above it. In other news, Apple gave up its most valued stock crown to Alphabet, but just barely. Both stocks have a market cap of just under $500 billion. And it was an awful week for traditional brick-and-mortar retailers, particularly Macy's. It fell over 16% for the week, and analysts are predicting that Amazon will take its place as the #1 U.S. apparel retailer by next year. And next week is another big week for retailers, with earnings due from Home Depot, TJX, Lowe's, Staples, Target, Ross Stores, Walmart, and several others. We've been noting for months now that we're in a choppy seesaw market, and we've also noted that the bull market that began in 2009 is getting very long in the tooth. So today, let's see what the monthly charts for the NASDAQ and the S&P 500 tell us about where we're at in the current market cycle. Here's where the NASDAQ peaked in March 2000 after the dot-com boom of the 90s. It then fell as much as 78% until finding a bottom in October 2002. Over the next 5 years, the NASDAQ gained 158% until peaking in October 2007. Then we had another severe bear market, which was of course sparked by the housing and financial crisis. This time, the NASDAQ fell 56% until bottoming out in March 2009. So, we had a strong 5-year bull market that was then followed by a sharp correction. And that brings us to the current bull cycle, which began in March 2009. One note of clarification here. A bear market is typically defined as a drop of at least 20% in the index. Smaller declines are considered intermediate corrections and do not wipe the slate clean and launch a new bull cycle. So, while we did momentarily see the NASDAQ drop just over 20% in October 2011, as you can see, it was not the kind of reset that we saw back in 2000 and 2007. So that means the current bull is now over 7 years old, and of course, it's been artificially propped up for quite a while to a large degree by years of stimulus or QE spending. Now, based on the peak that the NASDAQ hit in March, it has risen over 300% since March 2009. So that's essentially double the gain that the NASDAQ made in the prior bull cycle. Now, here's a monthly chart for the S&P 500. As you can see, it's followed essentially the same path as the NASDAQ since the 2000 peak and through the bull and bear markets that have followed. Now, we are not in the predicting business, but history shows that at some point, we're due for a bear market correction. That's never fun, but it is necessary. We need that to wipe the slate clean and set the stage for a new bull market driven by a new crop of leading stocks. So while you want to make money off of whatever opportunities are currently available, you also want to make sure that you're ready to handle a bear market whenever it eventually hits. And if you're not sure how to handle that situation, go to investors.com and click on the How to Invest tab. And from there, go to lesson number 3, How to Time the Stock Market. Scroll down and then click on the Get an Action Plan for each market direction. And on that page, check out the action plans for what to do when the market direction in the big picture says uptrend under pressure and when it says market in correction. And then also go back to the main page under How to Invest and click on lesson number 7, which talks about when to sell stocks. That has some very good tips on how to use sell rules to avoid any serious losses and protect your profits. Thanks for tuning in, and Amy will be back with us next week. And we want to remind you to also keep checking the Investing Action Plan and the Earnings Preview column, which helps you get ready for the coming week. You'll find links to that at investors.com/investingshow. We'll see you next week.